If you have a credit score, you're in the right place. I want to thank you for investing your time to click on this video. I make videos that focus on providing valuable, practical, and interesting information that can improve people's lives. If that's your interest, subscribe. And since everyone has a credit score, let's get started. Your credit score is like a report card for your money habits. It tells lenders how responsible you are with borrowing and repaying. Think of it as a numerical grade reflecting your financial trustworthiness. Ranging from 300 to 850, a higher score indicates better creditworthiness. Why should you care about this three-digit number? Because as long as it's the standard, it significantly impacts your financial life. A good credit score unlocks lower interest rates on loans, better credit card offers, and even easier apartment rentals. Imagine buying a car or a house with good credit. You'll likely secure a lower interest rate, saving you thousands of dollars over the loan's life and possibly even hundreds of dollars monthly. On the flip side, a low credit score can lead to higher interest rates, making borrowing more expensive. In some cases, it might even prevent you from getting approved for loans or renting your dream apartment. Several factors contribute to your credit score, each holding a different weight in the calculation. Understanding these factors can empower you to make informed financial decisions. Payment history. This is the most crucial factor, accounting for about 35% of your score. It tracks whether you pay your bills on time, including credit cards, utilities, and loans, amounts owed. This factor, making up around 30% of your score, considers how much debt you carry compared to your credit limit. Lower credit utilization, the ratio of debt to available credit, generally improves your score. Credit history. Length. Representing about 15% of your score, this factor considers the age of your credit accounts. A longer credit history demonstrating responsible credit management over time positively influences your score. Credit mix. Comprising 10% of your score, this factor considers the types of credit you use, such as credit cards, installment loans, or mortgages. A healthy mix of credit types can indicate responsible credit management. New credit. The final 10% considers how often you apply for new credit. Frequent credit applications can lower your score as it may signal financial instability to lenders. Let's illustrate the impact of credit scores with a few real-life scenarios. Imagine two individuals, Sarah and John, both wanting to buy a $250,000 house with a 30-year mortgage. Sarah, with a good credit score of 750, secures an interest rate of 4%. John, on the other hand, has a fair credit score of 620 and receives a 5.5% interest rate. Over the loan's life, Sarah will pay approximately $150,000 in interest, while John ends up paying over $210,000, a difference of $60,000. This example highlights the significant savings a good credit score can provide. Now consider renting an apartment. Landlords often check credit scores to assess a potential tenant's financial responsibility. With a good credit score, you're more likely to get approved and might even enjoy lower security deposits. Even in the job market, some employers consider credit scores during background checks, particularly for positions handling finances. A good credit score can provide a competitive edge in such situations. Improving your credit score doesn't require complicated strategies. Here are some simple, actionable steps you can implement today. Pay your bills on time. This is the single most effective way to improve your credit score. Set reminders or automate payments to avoid late fees and negative marks on your credit report. Reduce your credit utilization. Aim to keep your credit card balances below 30% of your credit limit, then work on reducing them to 10%. Paying down existing debt can significantly improve your credit utilization ratio. Check your credit report regularly. Request free credit reports annually from the major credit bureaus and review them for any errors or inaccuracies. Dispute any discrepancies promptly to ensure accurate reporting. Avoid opening too many new accounts. Every time you apply for credit, it creates a hard inquiry on your credit report, potentially lowering your score. Only apply for credit when necessary and space out your applications. Become an authorized user. If you have a family member or close friend with good credit, ask to become an authorized user on their credit card. This can help build your credit history without requiring you to open a new account. Maintaining a good credit score is crucial for long-term financial well-being. It empowers you to access better financial products and services, saving you money and opening doors to opportunities. By understanding the factors that influence your credit score and implementing the simple steps outlined above, you can take control of your financial future and enjoy the numerous benefits of good credit.